Separating fixed versus flexible expenses. Taking charge of your monthly cash flow begins with the fundamental act of categorizing your spending into two distinct types: fixed and flexible expenses. Fixed expenses are the non-negotiable pillars of your budget. Examples of such costs are rent, mortgage, car payments, insurance premium, and minimum debt payment that remain constant each month. These are obligations you must meet. In contrast, flexible expenses are the variable outflows that ebb and flow with your daily choices and lifestyle. This category includes groceries, dining out, entertainment, clothing, fuel, and even utilities to some degree. This separation is your primary tool for creating financial agency. Once your fixed expenses are accounted for, the total amount left represents your true discretionary spending power. This clarity instantly reveals where your opportunities lie. You cannot easily shrink your rent payment. However, you can strategically plan your grocery budget, consciously reduce dining out, or curtail subscription services. This process transforms budgeting from a feeling of deprivation into an exercise of strategic allocation. It allows you to intentionally direct your flexible spending towards your current priorities, whether that is accelerating debt payoff, building saving, or funding an experience, thereby ensuring your money flows in alignment with your goals, not just your habits. This simple act of separation is what makes a budget a living and breathing plan for your money, rather than just a historical record of where it went. Designing a simple income allocation plan. An income allocation plan organizes your money before you spend it. By assigning each portion of your income to a specific purpose, needs, obligations, and goals, you can make intentional decisions that prevent waste. This structure ensures your priorities are always covered without confusion or guesswork. An effective income allocation plan, often exemplified by methods like 50-30-20 rule, and operates as a proactive blueprint for your finances. Instead of spending first and hoping money remains for saving, this approach dictates that every dollar of your income has a designated role the moment it arrives. The core categories typically divide your take-home pay into essential needs, financial obligations, discretionary wants, and future-focused goals. This is not a detailed budget tracking, but it is a strategic framework that ensures your financial pillars are funded in order of importance, creating a clear and automatic structure for your cash flow. Implementing this simple division fundamentally transforms your relationship with money from reactive to directive. The mental burden of constant financial decision-making is drastically reduced because the major decisions are made upfront. You no longer wonder if you can afford to save or invest. You simply execute the plan, transferring the allocated amounts automatically. This system acts as a guardrail, ensuring your essential needs and future goals are protected before flexible spending begins. The profound benefit is psychological. It replaces anxiety and guesswork with clarity and control. By honoring your priorities first, you spend the remainder of your money with freedom and without guilt, knowing your financial foundation is securely in place. Monitoring where money leaks. Money leaks are unnoticed expenses that slowly drain your resources. Good examples are unnecessary subscriptions or frequent small purchases. Regular monitoring helps to eliminate these leaks and redirect your money to areas that matter. It is one of the easiest ways to strengthen your cash flow without increasing your income. Monitoring for money leaks is the essential practice of becoming a detective of your own daily spending. These leaks are not as such dramatic and large expenses. Instead, they are the small, recurring drips that go unnoticed precisely because of their size. Some of them are the streaming service you rarely watch, the premium app subscription you forgot about, the daily convenience store snack, or the habitual online shopping for minor items. Without scrutiny, these costs become silent background noise in your budget, collectively creating a significant diversion of funds away from your true priorities. The act of monitoring, therefore, involves conducting regular audits of your bank and credit card statements, with a specific focus on identifying these automated or thoughtless outflows. Plugging these leaks is a uniquely powerful financial action because it represents found money. Unlike cutting back on major and meaningful expenses, eliminating a forgotten subscription or reducing impulse buys requires minimal lifestyle sacrifice, but yields immediate cash flow improvement. This process does more than just recapture funds. It cultivates a heightened state of financial awareness and intentionality. Each leak you identify and stop reinforces your sense of control and proves that your financial destiny is shaped by small and consistent decisions. The reclaimed resources can then be surgically redirected, whether to build an emergency fund, pay down debt, or invest, creating a direct and positive impact on your financial health without the need to earn a single extra dollar. Preventing mid-month shortages. Preventing mid-month shortage requires shifting from a static, one-time budget to a dynamic, ongoing management of your cash flow. The pressure that arises halfway through the month is frequently a symptom of front-loaded spending, where freedom felt right after payday leads to a disproportionate discretionary purchases, leaving insufficient funds for latter needs. This cycle often stems from viewing a budget as a monthly total rather than a weekly or even daily allowances. Without conscious pacing, it becomes easy to overspend in the first 2 weeks on dining, entertainment, or shopping, creating a strain when essential bills for groceries, fuel, or utilities come due in the latter half. This pattern reveals a disconnect between your plan and your daily behavior, highlighting the need for more frequent financial checkpoint. The solution lies in implementing a simple and proactive review system. This involves a brief weekly or even bi-weekly assessment where you compare your actual spending against your planned allocations for flexible categories. This regular audit acts as an early warning system, allowing you to see if you are spending too quickly in one area while there is still ample time to consciously slow down in another. By making small and corrective adjustments in real time, such as preparing more meals at home after a week of frequent restaurant visits, you smooth out your financial expenditure across the entire month. This practice transforms your budget from a rigid document into a living tool, ensuring consistent stability. The profound benefit is the eradication of that familiar mid-month anxiety, replacing it with the confidence that you are actively steering your finances with clarity and control from the first day of the month to the last. If you found this tutorial helpful, please like, share, and subscribe for more expert-level personal finance lessons designed to help you build a stronger, more confident financial future.